Hello guys, in today's class we are going to study about the simple concepts of liquidity. We are going to look at the equal highs and equal lows concepts of liquidity. So there are two concepts here, equal highs and equal lows concepts of liquidity. So when we are talking about equal highs and equal lows, what we are basically saying that in equal highs there is a key, we find here a key resistance, a key resistance level here. So in this case, for us to know where we will have a sweep in liquidity, we are expecting the price to come from a downtrend, okay? It gets rejected by the key resistance level. It comes back and trades here along this consolidation area, okay? The price will come again, try to break that resistance level. It gets rejected and bounces back below. In this case, we will see that we are having first this level, okay, and this level. In our case, these are equal highs, okay, so these are equal highs and these are equal lows. All right, good. So the price came here, it broke through this break of structure here. If you compare it with that price, here we will get an imbalance, okay, or some will call it an FVG, a fair value gap. You can call it an FVG or a fair value gap. This is a resistance level. In any case, you can call it a supply zone, okay? So this one is a supply zone. This one is a consolidation formed by equal highs and equal lows, all right? Here, remember we had an imbalance here, an FVG. The price will come back, try to fill this imbalance. The price will be rejected by that price level, and the price will come back to this consolidation, breaks through these equal lows, and continue on a downtrend. Okay, good. So who will tell me where the liquidity sweep is? The liquidity sweep is expected to be around here. So this one was our liquidity sweep. Why? Because we are expecting stop loss levels to be around this place because of these equal highs. Here we are looking for many sellers to be taking positions here. So you will find ICT traders and smart money concepts traders taking their trades here, filling these stop loss orders here and continue trading downwards. Okay, so this one is what we call equal highs liquidity. When you come on the other hand and you are looking at equal lows liquidity, we are looking at a key support zone. We are looking at a key support zone. Let us say that this one is our key support level, which we can also call our demand zone. Okay, so this one is our demand zone. So we are definitely looking for price to come from this level to test that key support level. The price will retrace a bit, come into consolidation and try to break through this temporary equal highs level and equal lows level. Okay, so here we are finding equal highs, and here you are finding equal lows. Okay, so the price will come again, try to test that level. It gets rejected and moves on an uptrend. So what happens in this case? In this case, we have a BOS here, a break of structure there. After this break of structure, we find an imbalance. This one is an imbalance. Some will call it a fair value gap. Okay, the price will come enter into a consolidation here with equal highs and equal lows. If the price will manage to break through this low, we are saying that it has come to fill the imbalance of the fair value gap. It comes to retest this area. We have a liquidity, you have a liquidity sweep here, where we are taking stop losses of traders who had prematurely taken their buys here, and now we are feeling their stop losses by this liquidity sweep, and we are looking to trade on this price going to higher highs and higher lows and higher highs and higher lows, forming an uptrend. So this illustration is basically what we say equal highs and equal lows liquidity. So in forex trading, you either understand how to trade using these liquidity concepts, or you will become liquidity for other traders. Okay, so you can see those traders who had taken their buys here, and those traders who had taken their sells here, they became liquidity for those traders who now took their buys here and their sells here at the proper positions. Okay, good. So the equal highs and equal lows liquidity concepts will change your trading forever. If you do not understand what liquidity is and how it works in the market, you are going to lose more trades than you need to. But if you understand liquidity, you can capitalize on areas like this and these areas, okay, so that you can enter into trades where other traders are being stopped out. So in this class, I'm going to introduce you to the most simple forms of liquidity, which is equal highs and equal lows. I'm going to show you what liquidity is, why it happens, and why it is something that is going to consistently happen for the long term, and how you're going to take advantage of it to make consistent money in the financial markets. Okay, good. So what you're really looking at here is equal highs and equal lows, equal highs and equal lows. So this is how they look like in the real markets. Okay, good. Now, if you have ever traded support and resistance, you will see that they are very similar. Okay, we said that this is a resistance level, this is a support level, which became a demand zone, and this became a supply zone. Okay, so a collection of equal highs here in the market is what you see as a resistance level. Okay, equal lows are the exact opposite, as they are seen as the support level. Okay, but note there is a difference in how we trade resistance levels and support levels compared to liquidity concepts in trading. All right, you see, resistance level and support level traders will be looking to buy a retest of this support level. So you will find that the buy traders are looking to buy a retest of this support level. So when the market makes this equal lows here, those traders are trying to buy. Okay, in this case of resistance level, when the market is trying to make these equal highs there you will find traders trying to sell these positions. They retest at these equal highs. But remember, this does not always work. And it is because of the concept called liquidity, as we had witnessed around here. Okay? To define what is liquidity, liquidity in its simplest forms refers to buy and sell orders in the market, period. And we all know that markets are about selling and buying. So what really motivates price to move is liquidity. And that is why it is very important for us to study this concept and understand them correctly. Okay? Now, when we see a collection of these equal highs here, we know that there are going to be sellers around these places. Okay? Selling at each of this level. Okay? And we know that there are massive amount of orders beneath. Okay? There are massive amount of orders either here or here. All right, that is a fact. Okay, but here is the thing: the market reacts to orders. So basically what we are saying is that the only reason why the market moves is because there are large number of selling orders here and there are large number of buying orders here. And we are saying that liquidity is simple say selling and buying orders at either of these points. Because of liquidity, the market will be forced to be pulled in these buy orders, and it is pulled by these sell orders. So we always expect the market to come fill these imbalances, fair value gaps, and retest this demand zone or the key support level, and the market to reverse to an uptrend. The same is true when we come to the supply zone. Okay, good. Now look, there is a range here between this key resistance level and this equal lows. Okay, so along this range, there isn't going to be a huge number of buying and selling taking place because it is simply not an optimum point to get into that trade. We get trades from these highs. Okay, but look, when liquidity is swept along here and there is a liquidity sweep around there, around the equal highs and equal lows, we are going to see a significant level of reversals, okay, from these areas. This is what some people will call stop hands. Okay, why the word stop hunt? Remember, there were traders who took their sales there. There are traders who took their sales there. Okay, but we waited for the liquidity sweep to be swept here, and we entered our trades there, waiting for the market momentum to hit, and we are on our downtrends. Okay, in this case, you will find there were buyers who took positions there, others who traded here, and others who took their positions there. But we waited for this liquidity sweep here so that we could take our positions here and go with higher highs and higher lows on an uptrend. Okay, good. So you may have heard this term, the stop loss hands, or you may have never heard about this term, but I'm going to explain what happens here. So when people call this a stop hands, because once the market has triggered the stop losses of these sellers, then we get a significant move taking place to the downside. Okay, now it is not really a stop hunt because there are no institutional traders looking to take you out of your positions from here. No, that is not how the market works. But because there is a significant number of orders here, and these orders are stop loss orders, the market is forced to come and absorb these orders to get enough liquidity to enable the market to go down and down and down. Here, we find that there are numbers of stop loss orders here. So the market will be forced to come down, absorb these stop loss orders in order for it to have enough liquidity to go higher and higher and higher. Okay? If you have any issues identifying the equal highs and equal lows, remember you can always utilize the free indicators on your trading view, and you can utilize the equal high and equal low indicator by Lux Algo on your trading view to automatically detect and plot these two levels on your price chart so that you can identify liquidity easily. Okay, let us next go and deal with the question, the most important and relevant question in liquidity, and that is, where do we enter our trades and where do we exit? Remember, there are two models that will help us to answer this question, and those two models are the equal low entry model and equal highs entry models. Okay, so when we are talking about equal lows entry model, basically we are looking for buying positions, and when we are saying equal highs entry model, we are looking for selling positions. Here we are talking about the demand zone, here we are talking about the supply zone. So in that context, we will have an illustration of equal low entry model where we have a formation of an imbalance here, a fair value gap where price will gap up. Okay, it will come back to retest those lows, form a consolidation around this place, and the price will come down to test these areas. Okay, it will come down to test these areas. So this price is expected to come down from that place. So there is a formation of an imbalance here, IMB. This imbalance is also called a fair value gap. Okay, so we'll form this zone. This zone in this case is called a demand zone. Okay, so from this demand zone, the price will come, expectedly bounce off that demand zone and continue with the uptrend. Okay, continue with the uptrend. Remember that in this case we are having some equal lows here, okay, and some equal highs there. Okay, so our expected equal low entry model, we are expected to have our entries around this place. Okay, and for every entry that you get, remember, good risk management informs us that we must have a stop loss. So if you had your entries here, remember that your stop loss are expected to be maybe down here below this demand zone. So here we'll have your stop loss. And for every stop loss, you must have a take profit. So we will come and have our take profits here. Okay, if you are risking 1 to get 3, then your R will be risking 1 to get 3 Rs. Okay? If your risk to reward ratio is 1 to 2, then you'll be having 1 R to get 2 Rs. Okay? Good. So this is our equal low entry model. All right. So what about our equal highs entry model? Remember that one happens from a supply zone and it happens on a downtrend. All right. So in that case, remember the price would be in a downtrend. So let us say we are having this kind of an imbalance. Okay. The market to push down, okay, come and have this consolidation at around the, okay, we will, this imbalance that will have happened here, IMB, it is an imbalance. The imbalance, this fair value gap, will lead to the formation of a supply zone there. All right. Remember, we are having our equal lows at around there. Okay. The price will be tempted to come test this supply zone and then go onwards to its desired direction, which was a downtrend. Okay, so in this case, there is a fill of that imbalance, and here there is a fill of the fair value gap or the imbalance. Okay, so after the fill of this imbalance, we will enter. So we will have our entries here. We are having our entries there, and the most the most relevant places for us to place our stop loss will be above this supply zone. So this is where we will place our stop loss. Okay, and we will have our take profits here. Okay, and as we said, if your risk to reward ratio is 1 to 3, then you will have 1 R as your stop loss and 3 R's in case of the take profit or the reward. But if your risk to reward ratio is 1 to 2, then you will have 1 R as risk and 2 R's as the reward. So basically, this is our two entry models. Okay, so you can see here that if you have an uptrending market, okay, and you have this imbalance that has formed, it leaves an open demand zone. Okay, then this forms the equal lows that you can see here. Okay, so what we will do in this type of scenario, we will place our entries here, and the type of entries we will place are called, these are the buy limits. We will place some buy limits here. Okay, and consequently here we will place some sell limits. So that is our mode of entry are along here. Okay, on this demand zone. Okay, then we will place our stop loss beneath this demand zone, and our take profits, we will place them up here according to past price actions. Okay, so what you are just saying here, these are the highest probability positions that you can take. Okay, good. So this is where the market structure, because according to the market structure here, we are on an uptrend. Here we are on a downtrend. Okay, so when this market structure lines up with market efficiency, what is market efficiency? Remember, the formation of an imbalance here, the formation of an imbalance there, the market was inefficient. But when the price came and filled that imbalance or that fair value gap, now the market was efficient. All right, that led to the creation of this demand zone. Okay, so when we have such type of structure, market efficiency, and formation of the demand zone or supply zone, then we are set for good trades. Okay, so you see, these setups are not going to happen all the time, but remember, when you see them, remember it is definitely worth taking those positions because they are high probability trades. All right, so in a downtrend like this, we are looking for an open bar imbalance range. Okay, this range from here to here, forming a supply zone. Okay, and when the market comes here, and when these equal highs, these are equal highs. Okay, when these equal highs are formed and there is a sweep of this liquidity, okay, a fill of this imbalance, okay, then we can trade into the supply zone, take our sell limits, okay, and we have now the market respecting the downtrend, making lower highs and lower lows, giving us an amazing shorting opportunities. Okay, as I said, this kind of setups, they do not happen every time, but when I see them, I must take advantage of them. Okay, so remember, they are not going to happen every day, but when you see these kind of formations in the markets where you can see liquidity in conjunction with market structure, in conjunction with market efficiency, formation of supply and demand, please take advantage. These are the best trades that you can get. All right, so after looking at the two entry models, the equal lows and equal highs entry models, we are going to look at the importance of the equal highs and equal lows. So the first importance of the equal highs and equal lows is that they form liquidity zones. Okay, they form liquidity zones. Okay, so we're talking about equal highs and equal lows forming these liquidity zones. Okay, remember, price action that repeatedly reached to these equal lows, okay, and equal highs in this case, this can signal that there will be price creating these liquidity zones. All right, the second importance of the equal highs and equal lows is that they form potential reversal points. Okay, potential reversal points. In this case, you can see we were on a downtrend. Here you can see we were on an uptrend, but you can see price came, formed the equal lows here, took some liquidity sweep and went on to the previous direction. Okay, good. So when this price would reach these areas again, just know that there is equal and there is a high probability of price reversing from this area after forming consolidation here and continue with the downtrend. Okay, so the third importance of these equal highs and equal lows is that they help us to identify our entry and exit points. Okay, you can see clearly that after we identified these equal lows and equal highs and we noted some liquidity sweep here, we just entered our buy limits expecting an uptrend. The exact same opposite is applied here on the supply zone where we entered our sell limits waiting for to take the lower highs and lower lows. The fourth important point is that they help us to anticipate for this liquidity the sweep of liquidity. Okay, remember, the first step is to wait for the sweep of liquidity. Okay, so when the price breaks through these equal lows and these equal highs, okay, it sweeps liquidity. The sweep of liquidity is, in short, taking off your stop losses. Okay, knocking off stop losses is what we call liquidity. For those traders who had taken some premature sells there and some premature sells there and there, and for those traders who had taken some premature buys there, and they had placed their stop losses here, and this one had placed their stop losses here, so we knock out their stop losses, and this is what we call sweep of liquidity, waiting for potential continuation of this downtrend and potential continuation of this uptrend. Okay, so in summary, what we are saying is that the equal highs and equal lows are price levels that are repeatedly tested, indicating potential market reversals and consolidation points. Okay, so you see equal lows here and equal highs here suggests that here we form bullish trends. Okay, and here we form some bearish trends. That is why we said here we sell, and bullish trends meaning here we buy. Okay, good. So if you have just understood this simple concept of liquidity, you are good to go to identify and enter good trades in the markets. Okay, so if you are watching this from YouTube and you have gained value from this class, kindly subscribe, share, and like this video so that next time you may get notified when we will have our next class.